The last week has seen global risk appetite improve, although the Aussie dollar has struggled to capitalise and any rallies have proved fleeting. Earlier on in the week, global risk sentiment had improved, US data remained strong, equities were up and bond yields were moved higher. Although this narrative changed in recent sessions, with the focus again returning to trade tensions, with stories that President Trump is keen to press ahead with $200 billion of tariffs on Chinese imports as early as next week. At the same time, emerging market currencies have been hit very hard, with the Argentinian peso tumbling over 13% in a day, the Turkish lira and South African rand also under attack. Domestically, the Australian dollar recovered from the dramas in Canberra last week and the change of Prime Minister, but despite the improved backdrop, has still been the worst performing G10 currency over the last week. The local data this week didn't help either, with Q2 business capital expenditure declining 2.5% and businesses' plans for future spending also soft. This removes some of the upside potential for next week's Q2 GDP data to be released on Wednesday. In addition, the notoriously volatile dwelling approvals data showed a fall of 5.2%. This is in line with our expectation of renewed weakness in the housing sector. However, the biggest fall in the currency this week actually came earlier on, when Westpac raised mortgage rates 14 basis points. Now this follows similar moves from the smaller and the regional banks, but the market pounced on this move, presuming it means the other banks will follow suit and thus reducing the likelihood of any official move from the RBA. This saw a corresponding fall in interest rates, with markets pricing just a 20% chance of RBA tightening by this time next year. Westpac Economics recently extended their forecast for the RBA to remain on hold through 2018, 2019 and 2020. And partly this is due to the tightening of conditions we are already observing in the absence of RBA rate hikes. This tightening is coming from macroprudential policies from the banking regulator APRA and this rise in wholesale funding costs, which is being passed through to households and corporates. As we move from traditionally less liquid August into more normal trading conditions in September, it really feels like the US-China trade wars are heating up again and emerging markets haven't really stabilised. Domestic politics and local data has weighed on the currency, but the Australian dollar should be able to avoid a break of the mid-August lows near 72 cents if the US dollar continues to weaken. That said, it does look like the theme of Australian dollar underperformance could continue, especially if global risk appetite deteriorates further on emerging market concerns. Next week sees a busy local data slate. Retail sales on Monday, the RBA meet on Tuesday, to be followed by the Q2 GDP and trade balance data. For GDP, our economics team are picking a 0.6 growth rate for the quarter, or 2.7% for the year. US Labor Day holiday may thin markets a little, but we'll be watching for further developments on trade policy. Any deterioration set to impact on risk sentiment. While this could again weigh on the Aussie, again the August lows of 72 cents should hold. We'll be back to talk to you next week.